Welcome to this session of ZICA Academy tutorial on group accounts. In this lecture, I want to examine acquisitions achieved in stages. Acquisitions achieved in stages. This is my second video on acquisition achieved in stages, or steps acquisition, or piecemeal acquisition. So in this section, I want to examine the further acquisitions after control have been achieved. Further acquisitions after control have been achieved. In my earlier video, I've told you piecemeal acquisition. I said it's divided into piecemeal acquisitions. I said it's divided into one, where you want to increase your shareholding from simple investment to subsidiary. Another one, if you want to increase your shareholding from associates, from significant influence, that is from associates to subsidiary. And the third one is the one we want to examine, that is from subsidiary to subsidiary. And this is called further acquisitions after control have been achieved. Maybe you want to increase your shareholding here from 10% to 60%. That means your initial holding was 10% and you want to acquire additional 50% to make it 60%. Then from significant influence, maybe from 20% to 60%. Your initial holding was 20%, which is a significant influence. You want to acquire additional 40% in order to increase the holding from 20% to 60%. Now, if your initial holding is 55% and you want to acquire additional 5% in order to increase it from 55% to 60%, this is what is called equity adjustments, or transactions between owners. Transaction between the owners of the subsidiaries, which comprises the parent and the non-controlling interest. So this is the one we want to look at now, equity adjustment. Further acquisition after control have been achieved. It means if you want to say, for instance, you want to increase your shareholding from 70% to 80%. What are the steps you need to follow? The first step is to draw the group structure as usual. Draw the group structure. I've told you that the group structure is a diagram that explains the relationship between the members of the group. I've told you we have different forms of group structure. We have the simple group structure, which involves one parent and one subsidiary. Or you may have one parent, one subsidiary plus an associate. That is simple group structure. Then you may have complex group structure, which may take the form of fellow subsidiaries, where two or more companies are subsidiary of the same parent. Step 2, present the summary of subsidiary net asset at the date of the first purchase and at the date of the second purchase. You want to present the summary of the subsidiary net asset at the date of the first purchase, that is the first acquisition, and at the date of the second purchase, the second acquisition. Remember the summary of subsidiary net assets, summary of net assets. We used to have date of consolidation, then we used to have date of acquisition. Then the date of acquisition, for this purpose, we will divide it into first acquisition and second acquisition. Then let her post acquisition retained earnings after second acquisition. After second acquisition. So, remember our net assets comprises the share capital, the share premium, and retained earnings, which will be divided into pre and post. We have share capital, the DOC. At the date of first acquisition, the same amount will be there. At the date of the second acquisition, same amount will be there. Then share premium. At the date of the first acquisition, at the date, this is date of consolidation, at the date of first acquisition and the date of second acquisition, same amount will be there. Then retained earnings. You have the DOC. Then information about the retained earnings at the date of first acquisition will be provided in the question. The one at the date of the second acquisition will equally be provided. So the difference between the DOC and second acquisition will be post-acquisition retained earnings after second acquisition. This minus this. The difference between this minus this will be the post-acquisition retained earnings from the date of the first acquisition to the date of the second acquisition. Then if you have fair value adjustment, the DOC. So everything we normally have in the summary of net assets, same adjustment will need to be made here. But for this purpose, I will limit you to these ones. Then the step number 3 is to calculate goodwill on acquisition. Remember, goodwill is the excess of purchase consideration over the fair value of the net assets acquired. That is work number 3. Goodwill on acquisition. So it is goodwill at the date the first control, goodwill should be calculated at the date the first control is achieved, or the date the control was first achieved. If you are increasing your shareholding from 70% to 80%, on the first acquisition of 70%, control has been achieved before you increase your shareholding to 80%. That means goodwill should be calculated on the first acquisition of 70% that gives the entity the control. So that is goodwill. So we have goodwill, which is the purchase consideration. Purchase consideration. You have the NCI at acquisition, the non-controlling interest at acquisition, which should be valued on acquisition either by proportionate share of net asset method or fair value method. We deduct the fair value of net assets at the date of acquisition. Remember, I've told you it is first acquisition that should be used because goodwill should be calculated at the date the control was first achieved. Control was achieved on this first acquisition. It is at that stage that goodwill should be calculated, not the date the shareholding was increased. So you share impairment loss, you charge impairment loss against your goodwill. You arrive at the goodwill that will appear in the consolidated statement of financial position. To calculate the equity adjustment, you start with the consideration paid. Consideration paid, let me put to increase shareholding. Increase shareholding. Take for instance, if you are increasing your shareholding from 70% to 80%, certain consideration will be paid to acquire additional 10% to increase your shareholding. And if you want to increase your shareholding from 60% to 80%, that means certain amount of consideration will be paid on acquiring the additional 20% needed or required to increase your shareholding. So you have the consideration paid. Then you deduct the decrease in NCI. Decrease in NCI. Why decrease in NCI? Remember, if your shareholding was 60% and you want to increase it to 80%, your NCI here was 40%. What happens to the NCI? It has now reduced to 20% after your shareholdings was increased to 80%. That means NCI has decreased, decreased. The amount of the decrease there is 20%. It is the 20% that will be used. You apply the 20% on the net asset at the date of second acquisition. The net asset, this is second acquisition. You apply that decrease in NCI on the net asset at the date of the latter acquisition. So you have the decrease in NCI. So this will give you the equity adjustment. This equity adjustment could be plus or minus. So to know the correct movement in equity adjustment, you can raise a journal for this, journal entry. So in your journal entry, you have the debit side and the credit side. The consideration page, when considerations are paid, cash goes out. You credit cash book. Then, you are decreasing NCI. That means you are reducing your NCI. NCI normally have a credit balance. So if you are reducing it now, that means you are debiting the NCI. So you debit the non-controlling interest, NCI, with the decrease in NCI. Debit NCI with the decrease in NCI. So then it is possible you may debit. If you now look at the consideration page, let me say cash book. You are crediting your cash book with the consideration paid. It's always credited here. So what will now determine whether you will debit the equity adjustment here is the consideration and what have been debited. If what you debit here, if it is greater than this, that means the difference will be inserted at the credit side in order to agree it. But if the consideration page, if it is greater than the decrease in NCI you have at the debit side, if this credit side is greater than debit side, that means to agree it now, you will debit the journal. You debit it with the equity adjustment so that the total of the debit side will amount to what you have at the credit side. So we have equity adjustment. I've told you equity adjustment may take the debit or the credit entry. So it depends on the question. So it may take a debit entry in some question and it may be a credit item in some questions. So that is step number 4. Step number 5, calculate the consolidated retained earnings. Calculate the consolidated retained earnings. The starting point is the parent retained earnings, parent retained earnings as per statement of financial position. So that is the starting point. Then you now add the parent shares of post-acquisition retained earnings. Parent share of post-acquisition retained earnings of subsidiary from 1. Date of acquisition DOA to the date of second purchase. So the first shareholding, the first percentage acquired will be used to share this. If the first percentage acquired is 70%, that means you apply 70% on the post-acquisition retained earnings. So the difference between the retained earnings at the second acquisition, the difference between retained earnings on second acquisition and retained earnings on first acquisition, the difference between these two figures, that is what you are going to share here. Then from date of second acquisition to date of consolidation. So you share that. So it is the latter shareholdings that will be used. If the shareholding was increased from 60% to 80%, that means it is 80% that will be used. So how do you get that? The difference between the DOC here and the DOA in the second acquisition, this minus this, or what we have here in this working. So that is what will be shared there. Then you can have equity adjustment. Remember, I've told you this equity adjustment may either be positive or negative. So it depends on the question. Working number 6, non-controlling interest. So the starting point is the NCI at acquisition. Now have NCI share of post acquisition retained earnings from date of acquisition to date of second purchase. No, if the first shareholding is 70%, NCI will own 30%. So you apply 30% on post-acquisition retained earnings from the date of acquisition to the date of second purchase. Then We also have post-acquisition retained earnings from the date of second purchase to the date of consolidation. So decrease in NCI, we have to deduct that here. Decrease in non-controlling interest, you remove that. So this will give you the NCI that will appear in the consolidated statement of financial position. I want to take question as work example from BPP ACCA study test. The same question, this is SBR. I'm taking the question from BPP ACCA study test, SBR study test. And I'm also taking the same question from ICAN study test, CR or SBR. Please watch to the end for better understanding. Example, H bought 60% of S 2 years ago for $540 million. The balance on S retained earnings was $150 million. H bought 10% of S 1 year ago for $45 million. The balance on S retained earnings was $300 million at this date. Statement of financial position, H and S as at 31st December 2021. We have H and we have S. Amount in $1 million. Investment in S, 585. Other assets, 2,500 and 650. Total assets, 3,085 and 650. Equity, share capital, $100 million for H and $100 million for S. Retained earnings, 2,485 and 500. The total equity of H is 2,585 and that of S is 600. Current liabilities, H 500, S 50. Total equity and liabilities, H 3,085, S 50, 650. Required. Prepare the consolidated statement of financial position as at December 31st, 2021. Now, we want to have the solution to the question. I've told you the starting point is to draw the group structure. Group structure. H bought 60% of S 2 years ago. H bought 60% of S 2 years ago. 2 years ago. H also bought 10% of S 1 year ago. That same H bought 10% of S 1 year ago. So it means this further acquisition increases H holding from 60% to 70%. So this is simple group structure. One parent, one subsidiary. So let me remove this so that you will not confuse it with this shape. So it is simple group structure involving or containing one parent company and one subsidiary company. After the group structure, the next thing is the summary of subsidiaries' net assets. Summary of S net assets. You will have for the date of consolidation, which is the reporting date. Then we also have date of acquisition. This date of acquisition will be divided into two. One is 2 years ago, 2 years ago, and the second one is 1 year ago. So these are the two stages of acquisition. So we have them for the DOA. Then we may also have post-acquisition retained earnings. The retained earnings that relate to post-acquisition, that is after the second acquisition, which took place 1 year ago. So the amount is in $1 million, $1 million. Equity section of the statement of financial position, we have share capital S 100, retained earnings S 50. So share capital of S is $100 million. Retained earnings of S is 500. So acquisition 1 year ago, the share capital will be 100 million. Then, acquisition 2 years ago. And for 1 year ago acquisition, DOA, the share capital will still be 100 million. Then the retained earnings. How much was the pre-acquisition retained earnings 1 year ago and the pre-acquisition retained earnings 2 years ago? Now, you were told H bought 60% of S 2 years ago for $540 million. The balance on S retained earnings was $150 million. The retained earnings 2 years ago, that is $150 million. Then H bought 10% of S 1 year ago for $45 million. The balance on S retained earnings was $300 million at this date. The retained earnings of S 1 year ago was $300 million. How much is the post-acquisition retained earnings after this second acquisition? So the share capital, 100 minus 100, ni. Then 500 minus 300. Then post-acquisition, we have 200. Remember, the shareholding of S has increased from 60% to 70%. It means 1 year ago, the shareholding is 70%. 2 years ago, the holding was 60%. The NCI 2 years ago was 40%, and the NCI 1 year ago has now reduced to 30%. So these are the net assets of S. So what is the total? Here you have 600. Here you have 250. Here we have 400. Here it is still 200. Now, the next thing is to if this is working number 1 and this is working number 2, the next step is to calculate goodwill on acquisition of S1. Acquisition of S, that is calculation of goodwill. Goodwill will be calculated at the date the first control is achieved. The first control was achieved on acquisition of the first 60% interest in S. So it means we will calculate goodwill on acquisition of 60%, not when the holding increases to 70%. It was on initial control of 60%. So when control was achieved on the first acquisition of 60%, that is when goodwill will be calculated. To calculate goodwill, the starting point is the purchase consideration. Purchase consideration. Purchase consideration. How much was the consideration paid on acquisition of the first holding? H bought 60% of S 2 years ago for 540 million. So the consideration paid on acquisition of the first shares is 540 million. This question is obtained from ACCA study test by BPP, and the same question is in ICAN study test by Emily Wolf Publishers. So now, after the consideration paid, the next item is the non-controlling interest at acquisition. Since the policy is not stated, so you assume the policy to be proportionate share of subsidiary net asset. Now, since 60% was acquired, NCI will own 40%. 40% of the net asset at the date of acquisition, initial acquisition, which took place 2 years ago, the net asset amounted to 250 million. 250 million. So 40% of 250 million, that gives us 100 million. If you add the 100 million to 540 million, then you have 640 million. Then you now deduct the fair value of net assets at the date of acquisition, and that amounted to 250 million. If you subtract 250 million from 640 million, we have 390 million. That is the goodwill that will appear in the consolidated statement of financial position. Working number 4. After goodwill, the next working is equity adjustment. Equity adjustment. I've told you to calculate the equity adjustment. You have the purchase consideration, amount paid to increase the shareholding from 60% to 70%. So the consideration paid amounted to 45 million. You were to H bought 10% of S 1 year ago for 45 million naira. So that consideration amounted to 45 million naira. So you have 45 million. After the consideration paid, then you have decrease in NCI. Remember, your NCI was initially 40% on acquisition of the first holding of 60%. When 60% was acquired, NCI was 40%. But now the holding has been increased from 60% to 70%. That means the NCI will reduce by 10%. It will now reduce to 30%. Decrease in NCI. I've told you that the decrease in NCI, I said, is the share of net assets given up by the NCI at the date of the second purchase. Share of the net asset given up. The net asset given up at the date of the second purchase is 400 million. So NCI given up now, decrease in NCI will be 10% of 400 million. That gives us 40 million. If you subtract the 40 million, then you have 5 million as the equity adjustment. So you have equity adjustment of 5 million. Equity adjustment. You can raise a journal for this. You can raise a journal for this item, for this equity adjustment. Let's have a journal entry. So journal entry. You have the credit side, you have the debit side. Amount is in $1 million. The purchase consideration they paid, you credit cash book. The consideration will be credited to you. Cash and debit the investment in subsidiary. decrease in NCI. So we debit non-controlling interest. You debit the non-controlling interest with the decrease in NCI of 40 million. You debit the retained earnings with equity adjustment of 5 million. Then you now credit cash or you credit bank with the purchase consideration paid, which amounted to 45 million. This is the journal entry for this transaction. The total is 45 million. That is the journal entry. Before we take the other workings, let's start the consolidation. We have each group. Each is the name of the parent, and it is a group of companies. So each group consolidated statement of financial position as at December 31st, 20x1. So the starting point is the non-current assets. Non-current assets. So if you check the assets section, the first item you can see there is investment. And this investment have been used to calculate goodwill that was reported in working number 3. And we have goodwill of 390 million. So, and this goodwill, that is the only non-current asset we have in this question. So we have goodwill of 390 million. The investment, that is the consideration, have been used. If you look at this consideration, remember 45 million was paid on acquisition of the second investment, and 540 million was paid on first acquisition. 540 plus 45, that is 585, and that is what made up the 585 million here. So this 540 million was paid in acquiring 60%, and in acquiring 10% additional investment, 45 million was paid. So that is total 585 million. Then we have current assets. So we can just have assets. So we can have assets if you don't want to categorize, since this other asset, we don't know what it belongs to. So let me just have assets. Then we have other assets. Other assets. It could be current, it may be non-current. We have 2,500 plus 650. If you sum them up, that is totaled 25 plus 650, that is total 3,150. If you add it to the 390 million, then you have 3,540 million naira dollar. This is the total assets. After total assets, we have equity. After total assets. So now let's go to the equity section of the statement of financial position. We have share capital there. The share capital, that of the parent, amounted to 100 million. The share capital of the parent amounted to 100 million. So we have share capital. The share capital of the parent, 100 million. After share capital, the working number 5, we have retained earnings. As usual, we normally start with the retained earnings of the parent as per the statement of financial position, which amounted to 2,485,000,000 naira. We have each retained earnings as per statement of financial position, 2,485,000,000. Then we now have each share of post acquisition retained earnings of S from the first one, date of acquisition to the date of second purchase. No, the holding from the date of acquisition to the date of second purchase was 60%. And how much was the post-acquisition retained earnings? You know, the pre-acquisition retained earnings from the date of acquisition, amounted to 150. Then the second purchase, the holding increased to, the retained earnings was 300 million. That means the one that relates to the post-acquisition period from the date of acquisition to the date of second purchase, that is 300 million minus 150 million. So, and the holding was 60%. 60% of 300 minus 150. 300 million minus 150 million. So we have 300 minus 150. That gives us 150. Then 60% of that gives us 90 million. Then from the date of second purchase to the date of consolidation. Remember, the holding has now increased from 60% to 70%. How much was the post-acquisition retained earnings? The date of consolidation will have 500 and pre-acquisition amounted to 300. That means post-acquisition will be 200 million. That is 500 minus 300. 500 minus 300, which is 200 million, which is the post-acquisition. Then this gives us 200. 70% of 200 million, that gives us 140 million. Then we also have equity adjustment. Equity adjustment. We said retained earnings will be debited with the sum of 5 million obtained from working number 4. So, no, the 5 million, and that is what we raised a journal entry for, this equity adjustment. So we said retained earnings will be debited with 5 million. That means 5 million will be subtracted from the consolidated retained earnings. So we have equity adjustment of 5 million. So the consolidated retained earnings now will be 2485 plus 90 plus 140 minus 5. That gives us 2,710. 2,710. So this 2,710 will be recognized as retained earnings. That is working number 5. 2,710. If you add it to 100, we have 2,810. After retained earnings, the next item will be non-controlling interest. Non-controlling interest. Let's have that as working number 6. Working number 6. Calculation of non-controlling interest. The starting point is non-controlling interest at the date of acquisition. You mean the first acquisition? No, the first acquisition was 60%, and the percentage attributable to non-controlling interest was 40%. So you have 40% of the net assets at the date of acquisition. Since the group policy is not stated to be fair value, so I've told you should assume the proportionate share of net assets. So you have the non-controlling interest on acquisition to be 100 million. The next item to consider is the decrease in non-controlling interest, decrease in NCI from working number 4. So the working number 4 was the working that shows the equity adjustment. And from that working, we said decrease in NCI was 40 million, which was to be debited to non-controlling interest. If you are debiting the non-controlling interest, that means you are subtracting that amount from the NCI figure. So you have 40 million to be debited to NCI. Then after that, you have NCI share of post acquisition retained earnings of S from date of acquisition to date of second purchase, from the date of acquisition to the date of second purchase. The NCI was 40%. And the net asset then, the post-acquisition retained earnings was 300 million minus 150 million. So that will be 300 minus 150, which is 150 million. So the NCI will be 40% of 150 million. That gives us 60 million. Then from date of second purchase to the date of consolidation. That is from the date of second purchase to the reporting date. So what will be the NCI? The NCI has now reduced to 30% since the shareholding has increased to 70%. That means NCI will be 30%. 30% of how much is the post-acquisition profit? From date of consolidation, we have 500 million minus 300 million. So you have 200 million, which is this. So 500 minus 300, so which is 200 million. The 30% of 200 million, that gives us 60 million. 40% of 150, let me confirm. That is 60. 30% of 200, that is also 60. Okay. Now this is the non-controlling interest. So 100 minus 40 plus 60 plus 60. That is totaled 180 million. Therefore, non-controlling interest that will appear in the consolidated statement of financial position amounted to 180 million as calculated. So if you add the 180 million to 2,810, then you have 2,990 million. This is the total equity, total shareholders' equity. After the shareholders' equity, then we have current liabilities. So the current liabilities, we have that of H, 500, that of S, 50. So current liabilities, H, 500, S, 50. That is totaled 550. If you add the 550 to 2,990, 2,990 plus 550. So we have 3,540. This is total equity and liabilities. Our total equity and liabilities agree with the total asset of 3,540. This marked the end of the solution to this question. In my next video, I will take standard worked example from the past examination. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.